more about the markets. Joining us now is Nick Colas. He's co-founder of DataTrek Research. Is sentiment reflecting what we just talked about? What did you say, Nick?
Sentiment in terms of, say, how retail investors feel about the market?
How much after the most hated rally in history last year?
Yeah.
I still don't feel like people are as bullish as we've seen in previous, what would form a top, are they?
That's absolutely true. We've just seen money flows turn positive in mutual funds and ETFs in the past couple of weeks. They're still down on the year for U.S. equities. So we're maybe 2 weeks into some kind of interest in the market, but nothing more than that.
Looking since the pandemic, I mean, if you could find a way for the market to do what it's supposed to do, and that is confound everyone, we close the economy and the S&P doubles, and all these pandemic beneficiaries take the NASDAQ to new highs. Then we consolidate. How long? For like 2 years. We went down and consolidated, and everyone thought we were going to have to test the lows, which we never did. So where are we now historically? Are we headed to significant all-time highs in the next couple of years, do you think?
The short answer is absolutely, in my view. Absolutely. We're in what I call a mid-cycle market. We're not in a recession or close to one, and we're not facing something that's going to be pretty dire. And those broad middle parts of the market, 82 to 89, or the 1990s, or 03 to 07, or 2012 to 2019, these are all long periods of economic expansion and stock market growth. In all those years I just mentioned, there's only one down year. It was 2018, that was down 4%. So we're just starting that phase now.
Why in the world would the Fed be cutting interest rates in an environment like that?
Well, the Fed had to jack rates to fight inflation, but they're, I think, quite scared of cutting too little in the face of what is now a slowdown in labor markets. We're beginning to see some of those cracks form in labor markets, particularly at sort of the top end. And so they don't want to be blamed for the next recession, particularly going into an election year. That's why Powell pivoted in December to 3 cuts from 2, and that's why they're staying with that messaging now.
We just, since 1981, all we do is go up. It's really, we haven't had a 10-year period where we went nowhere. But is that never going to happen again? Is that
we had close to one, right, from kind of 1997, 98 to 07.
On the NASDAQ, maybe.
On the S&P, we had 1550 both times, kind of topped out there and then went down.
That was financial crisis related? Or
that was sort of beginning of dot-com bubble through. We had 1550 both times and then came down to 670, 680 on the S&P twice. Yeah. Aside from that, we've had a pretty good run. And that's what markets tend to do because the U.S. economy is generally strong, because the U.S. creates great companies and allows them to grow. So we have a long track record of
drives
success.
The Justice Department crazy, by the way.
They're not a fan. Not always a fan. Yeah, that's exactly right.
Right. If only we could be like Europe. People lost their jobs looking for 3,000 on the S&P and just holding to that. And we know some of them. They don't come on anymore. But we're at 5,200 now. Yeah. So 3,000 to 5,200, just to show you. Just last year, they were looking for 3,000. Yeah. So what's next? Is 6,000 next?
Okay, I think you have a long, steady pace, probably 3 to 5 years.
For what? 10,000?
To basically a double over 5 years.
Come on.
Yeah.
From here?
Yeah.
That is 10,000.
That's the way markets work. That's the history of the markets. My worry is more that it happens too fast, because we're getting this conflation of 2 kind of prior periods, the mid-'80s, where the Fed began to cut rates in 84 from 11 down to 6%, and the S&P doubled from 85, 86 through September 87, and then crashed. And then we're getting also the tech bubble kind of vibe with Gen AI. So we're getting this conflation or confluence of 2 very important trends. And my worry is we get these kind of returns over 24 months instead of 5 years.
Can technology like AI save us from our debt problems?
I don't know what can. I'm not sure Gen AI can. The only vague hope is that it improves productivity so much.
That's what I mean.
That we get that kind of growth. It's still way too early days. And productivity, as you know, is a very hard thing to measure and a very hard thing to improve. So, yeah, we can hope, and that seems like a reasonable argument, but the data is not there yet to support it.
We can't count on policymakers to do the right things on the revenue or spending side.
That's very fair. I don't see any other I think you're right.
Then the private sector is going to have to save us, even if there's headwinds from what the federal government or what the government decides to do. It's going to be AI and innovation that might save us.
And that's been the way for the last 25, 30 years, as long as I've been in markets.
Dan Ives, Wedbush Securities Managing Director, joins us now. He's got an outperform rating on the stock, $250 price target. Dan, why are you not worried about what you're hearing from the Connecticut AG and from the Department of Justice?
Yeah, I think, first of all, he does a great job, in Connecticut, and I think they raise great points. Our whole point is the business model for Apple, we believe, is defendable. And I think as they go through this, we do not see the services as at risk. And I think right now what's really reflected in the stock is worries that they're going to have to, from a commission perspective, they're going to have to change their business model. They've defended this before. And we've talked about scenario analysis. I'm not saying that they're not going to come out unscraped. But I believe what's baked in here right now is $20, $30 of, in my opinion, of an overhang.
But at the very least, people say it's going to be a big distraction. And to David's point, it's going to take a lot of time, a lot of effort, a lot of meetings with lawyers and regulators. And that ultimately could be painful for a company, couldn't it?
Yeah, I think it could be painful. And no doubt, hand-holding investors through this yesterday, there's obviously a lot of agita. But if you go back to Microsoft when I covered them back in the 90s, I think the biggest mistake they made was ultimately being distracted, not being aggressive. And I think Gates would say that's probably one of their biggest regrets. When you look at Apple, I think they're going to double down. They're going to introduce AI at WWDC in June. We talk about that. They're not, in my opinion, going to back away. And I view this as more, bark will ultimately be worse than a bite. But at one point, they will have to get to a point where they either settle from a fine or ultimately go down some path, business model tweaks, but they will defend this moat.
Yeah, I mean, technology changes so quickly. That's the other part of it. It's hard to really anticipate what the world's going to be like if and when that day comes. Speaking of which, though, investors continue to look for a catalyst here that's going to move the stock once again higher. You keep pointing to June.
Yeah.
What was your reaction to the story about the Gemini chatbot being used perhaps as sort of one of the AI engines on the phone? Where are you in terms of how you're thinking about what they're going to tell us come June?
Well, I think that's a smart strategy because that's already a fully built product. And obviously validation for Google and Gemini. But I do believe Apple, it's a dual path in terms of the App Store that we view is really going to be an AI App Store, a subscription-based model. They will have their own LLMs built in. But when you look what Google has built, that's smart right now to partner with them. And I think when you look at going forward, OpenAI potentially could have been in there as well. This is not the time for them to look on the outside looking in. It's a time for them to aggressively double down. And I think the AI strategy, units starting to, I believe, at least start to get back to growth in China. Cooks in China this week, that's not coincidental. I think that's another sort of showing we are not leaving China. We're doubling down.
But the AI moving to the edge, moving to the device, that's going to motivate people to go out and buy the next iteration of the iPhone?
You have 270 million iPhone users that have been upgraded in 4+ years. That right now is my focus fundamentally, even though clearly, what we saw yesterday with the lawsuit is an overhang.
Let's bring in Rich Clarida, former vice chairman of the Federal Reserve and global economic advisor at PIMCO. He looks younger. He looks more relaxed. He looks. Life is good, is it not?
There is life after the Fed, for sure.
It's hard. It's hard work. I sound like W. It's hard work, don't I?
I worked for him too.
Yeah, the decider. It is hard, and I have a lot of compassion or empathy for what Chair Powell and the rest of the Fed are up against. Everything's nuanced. Everything's gray. Did he say the right things? Are we on the right path?
I think we're on the right path, but the chair does have a complex message, again, signaling 3 rate cuts, but inflation is obviously not 2%. The goal is 2%. So he's trying to convey a message that they're going to start cutting with inflation at 2 point something, and if anything, they revised up the economic outlook. I can see why markets liked it.
Is
because
that messaging? You think that this was his shift to say, okay, inflation doesn't have to get to 2%? This is...
Well, I think that shift has been in play for a long time. it was hypothetical a year ago when I did your show. Now it is actually 2 point something. But yes, I think they believe that it is appropriate in the baseline to start cutting before inflation gets to 2. He was very clear in that press conference. There's two-sided risk now. I think the last time I did your show, I said they're only looking at inflation. Now they're looking at the risk that if they keep rates high for too long, pushes the economy into a downturn. So they're trying to navigate a pretty careful landing right here.
I thought it went from one side to the other side, not two-sided. It very strangely went from inflation to recession risk.
Well, what I think is going on here is the delicate balance that he's trying to navigate is financial conditions will very naturally start to ease when they get the sense the Fed is done in cutting. And then, of course, that improves the economic outlook and potentially makes it harder to get inflation down to 2. What was interesting, Joe and Becky, at the press conference is when he got questions on financial conditions, he asserted, we think that they're tighter, but if you look at any indicator, stock prices, credit spreads, even rates, they're a lot lower than they were in November.
We've done a
lot easier than they were in November.
A lot of hard work with a good outcome so far, normalizing interest rates. Why give that back? Now we have some dry powder for the next thing that happens.
But why cut now?
Right.
Yeah.
Well, no, it's really, again, not mission accomplished. But
you're not sold. I can tell you're not sold on whether we should cut.
I think there's more two-sided risk here that inflation stays sticky and stubborn. And I think that's a risk they should be willing to take to start cutting. But you shouldn't eliminate or ignore the fact that there is a risk, And I'll make one point. The Fed targets PCE inflation. Sorry, it sounds a little wonky for the crowd, but the CPI index, which I think people understand better, is somewhere in the high 3s. In fact, the last 3 months running at 4. So if the Fed were targeting CPI right now, we wouldn't even be discussing rate cuts.
Well, you must be convinced, or Chair Powell must be convinced that we're restrictive.
Oh, yes, he asserts that, and the Fed believes they are restrictive.
That's the only reason to even be considering cuts.
Oh, sure. In fact, a very good point, because when he gets questions along the lines of what if the inflation's more sticky and stubborn, he's not really suggesting any more rate hikes. He's just saying we can stay on hold longer. So that is the thinking on the committee.
You think there's a chance that they make it through this year without any rate cuts?
Becky, there's always a chance, but I think they think not only that they're done, but that they're going to be cutting. The dots indicate that. Obviously, the dots have their problems, but the dots indicate that. So, yes, there is a chance, but I think under a pretty broad range of scenarios, they're going to get at least one cut in this year.
That's amazing.
It's not 3.
Potentially not 3. Let me say this, and maybe here I should say this may be more of a hope than a forecast. I do hope that the Fed really moves into data-dependent mode, because there can be a very good case, if inflation is sticky and stubborn, that they shouldn't deliver 3 cuts this year.
If CPI is high for another month, I mean, that would be, I think, all you would need to see to say, hey, we're not doing anything till we see where this is headed.
Well, but I think they've now had 4 press conferences in a row, November, December, January, and now March, where they're basically signaling they want to get that rate cut in. So I think it's going to happen.
Do you think any of that is tied to the potential for some of the smaller banks to run into trouble if they don't get rate cuts because they have commercial real estate and other things on their books?
I think probably not. I think they have a pretty good sense that the banking system as a whole has a lot of liquidity. Capital is very profitable. And I think they have the tools to deal with individual situations if they need to. So my sense is that that's not a driving factor right now.
They supposedly respect the lag, I guess.
Yeah.
Do you think they know anything that's not public knowledge about some weakness somewhere in the economy? Because if the economy stays like it is, if the S&P keeps hitting new highs, if, Bitcoin and speculative assets.
My son today texted me, look at Reddit, Dad. I don't even know what Reddit is.
If all these things keep happening, I just don't, and they really don't know that that the economy is facing some, we talked about, that's not the Titanic, but maybe there is something under the water. You just see the top of the iceberg, and maybe there is something big. Is there something big under the water?
Well, not that I know. I think everyone, including the chair in the press conference, acknowledged that everyone knows that commercial real estate, central business district office, is not coming back to where it was pre-pandemic, and that exposure is in both the banking system and in the securities markets. I don't think they think anything is imminent. It's more of a slow burn, a slow grind through revaluing and liquidating those assets.
Joining us is Ron Insana, CNBC senior analyst and commentator, also chief market strategist at Dynasty Financial Partners. And Mike Bailey is a director of research with FBB Capital Partners. Welcome to both of you. Mike, let me start with you. In the last hour, Michael Farr, another Michael, called today's market bubbly, but not a bubble. So I guess carbonated, but not overflowing. What's your view?
I think that's directionally correct. I think we're probably closer to a bubble now than we were, let's say, a year ago. I think the question is, will it pop? I think we certainly saw a little bit of a bubble pop in late 21. Everything was going up. There was, irrational exuberance, et cetera. We have to scroll ahead and say, well, what's going on right now? Are there real fundamental reasons driving the market? Let's go to AI. Let's look at NVIDIA. I mean, they are generating massive growth. These are real dollars. They're real huge companies are buying these chips. There's a whole ecosystem around it. So we are seeing a lot of dramatic growth out there. Yes, that is driving earnings up. That's driving stock prices up. Are we in a bubble? I don't think we're quite there yet, but I think we're definitely getting closer. And I think investors really got to be very careful about what they're buying. If they've got something that's really moved up, start to think about rebalancing. But so I think
there may be, Ron, portions of the market that are in bubble territory, if you want to call it, but others that are not so inflated.
Yeah, much of the market's not inflated, although we have seen a broadening of late, and so markets, areas of the market that have been underperforming, small caps and the like, but starting to turn higher. A bubble's a very specific word. It implies a lot of things, including public euphoria, heavy issuance of new stock, which we've not seen yet. We've seen a little bit of it starting to take place now, but
well, there's certainly euphoria surrounding AI and
although
a lot. I mean, what do people go? How about NVIDIA? I mean, that's what people talk about. It's like CMGI 25 years ago.
Well, no, I mean, CMGI had zero.
I got you.
Business. Being a publicly traded company.
No, I understand that. These were not real.
Lycos that actually got sold to somebody else.
But the stock performed as though the stock was the darling.
Oh, absolutely. David Weatherall was a billionaire. I remember Sue Herrera and I sat with him at a Fidelity event and asked him what he was going to do now that he was a billionaire, and he said he was going to get a plane. So that was frothy, and that was even early. That was like 97, 98.
Yeah.
So bubbles inflating. I mean, we're in the infrastructure phase of the AI build out. We haven't reached the implementation phase, which is going to start coming, I think, in waves now. And you've talked to venture capitalists who are looking at the implications for healthcare, financial services, wide variety of different businesses. I was doing an interview yesterday at an event, and even not just the news business, but the legal business, that profession, everything's going to be touched by it. The question is, how do markets respond, and when do we see the type of euphoria that we saw between 1995 and all the way through 1999 into early 2000? I don't think we're quite there yet.
No.
It's interesting because we saw at the time in the 90s the dot-com bubble in the early 2000s, but it turns out in the long run, if you look at history, that there was a reason for that euphoria. It may have been too compressed and too focused in that moment, but over the long run, some of those ideas and the long-term confidence that the internet was going to change the world and power other companies was true, and that's true of AI. What's interesting, though, is really old-fashioned investments. For instance, you look at commodities, and what we're seeing with commodities, Ron, there's opportunity in the same kinds of investments our grandparents may have made.
Yeah, some. I mean, and we've seen some agricultural commodities turn higher. We've seen copper and corn, go up in tandem. Energy has moved up a bit, although it's moderated lately. And so, yeah, I think it's like any other environment. There's usually a multiplicity of choices to make when you're looking at the investment environment. The difference, I think, between, as you say, the similarity with the 1990s is that, and I'll quote both Roger McNamee and David Faber. So Roger talked about how the U.S. economy thrives off of bubbles because we build out all this brand new infrastructure. There is a period where it crashes. In 1999, David Faber was talking about terminal values. Did these stocks reach their peak even before they saw peak profits? And that happened with Amazon. It happened with a lot. Some went out of business. Pets.com is no longer there, but Chewy is.
Yeah.
So we've seen, we used up all the dark fiber that we thought was going to lay idle for decades. Instead, it's now we don't even have enough capacity to continue building out what we're doing right now.
Today's market action with our market panel, Tom Lee of Fundstrat and Jose Rasco of HSBC Global Private Banking and Wealth. Good afternoon to you both. I mean, it was a record week for the S&P, the Dow, and the NASDAQ, even though we slipped here in trading for the Dow and the S&P. Just the fact that we did reach new highs this week. Tom, I will start with you. How much of this is Fed? How much of this is ongoing AI enthusiasm? How much of this is economic data that continues to surprise to the upside?
It's all of the above, Morgan. It's always a good sign when not only is the S&P 500 making a new all-time high and building on 4 consecutive months of gains, but it's coming when the other important indices like the NASDAQ and the Dow confirm those highs. I think we got a lot of good economic data recently. The economy is very resilient and corporate profits have been also surprising to the upside. But now we have monetary policy that is confirmed to be dovish, and at a time when there's $6 trillion of cash on the sidelines. So to me, these are all positive signals for stocks to make further gains. And I think sentiment continues to be overly cautious.
Okay. Jose, how do you see this, especially as we have seen market leadership broaden out as well? You've now got something like 80% of the S&P 500 constituents trading above 200-day moving averages. And we did get not one, but 2 strong IPO debuts in this market this week, too.
Yeah, look, we agree with a lot with what Tom said, but I think if you look, the cyclical side of the economy is probably going to slow because rates are high. And even if the Fed cuts, rates are still high. So the cyclical side, we should see some slowing. But you've got the 4 underlying secular themes that are going to continue to drive the economy upward. And we think multiples out and the market upward as well. So we're still bullish on U.S. equities. And remember 94, 95. At the beginning, it was a couple of stocks that led this whole thing on the tech side, and that broadened out. And we have not yet seen the power of the productivity gains we're going to see here from AI and a host of other technologies, right? And I think that has yet to happen, and that's going to help boost earnings as we go forward. And that's positive for markets. So yeah, we're bullish as well.
Okay, so Jose, when I hear you talk about cyclical parts of the market, maybe perhaps slowing here. I mean, we do have industrials trading at a record high, materials, some of these other more cyclical sectors. Does that mean that you take a step back as an investor right now and say maybe take some profits, maybe put your money to work in other parts of the broader market?
I think you're going to see that just from a valuation perspective, right? Growth has outperformed value dramatically this year, right? Year to date. And I think that's going to factor into people's decisions. You can dollar cost average your way into some pretty good stories in other sectors, but the growth perspective remains in place. And we think that's where you want to be. Remember, look at the Philly Fed from yesterday. The top line number was not great, but if you look at prices paid, came down a ton. New orders soared. And most importantly is the Philly Fed CapEx index. And that's something that for Tom's ideas and mine is crucial because it's telling you corporate America is still investing in long-term planning to build a more resilient economy. And they want to make sure they're on the front burner of that, not at the end of the train. So I think you're going to continue to see that. That's going to help lift valuations. But clearly, there's going to be some rotation of value here as growth has outperformed dramatically.